Welcome back to my channel, Balance Sheets Matter. Today we're going to be looking at Leggett Platt Inc., also known as Leg stock. I recently had a subscriber ask a question about this on one of my other videos, and it also is a stock I've been looking at and actually currently buying a little bit. So we're going to do a stock analysis on Leg stock today. But before we get into that, make sure, of course, to subscribe to my channel, Balance Sheets Matter. I do individual stock analysis videos, sometimes some other stuff. So if you want to get ideas on potential good stocks to buy or value traps to avoid, make sure to subscribe to my channel. And if you do want me to look at a stock in the future, leave it in the comments below, ask me a question, as I do frequently do that for subscriber requests. So let's dive into the analysis here. A lot of people know basically Leggett Platt as one of these dividend aristocrats, but there's been quite a big dip in stock price. You can see on the little guru focus value band here, it was basically as high as it looks like, in the $50 range, 57 at least here, and it's fallen to below 20. So it's been quite a large drop. It's saying this could be a possible value trap, or this could be a deep value buy. Another few little statistics to go over is right now their dividend yield is extremely high at almost 10%, but their payout ratio is 1.3. So the question is, will they be able to sustain this dividend? We'll have to get into that a little bit later. But let's dive into the financials to start here. You can basically see the green line here on the right. This is their long-term revenue trend. They have ups, they have downs. They are economically sensitive. You can kind of see they peaked in 2004, and then their sales declined into the 2009 recession. And now we've had basically in 2019, then 2020 there was a dip, and now we're having another dip again. So it's just going to be a short-term dip. It's going to be a longer dip. We're going to look at some things to consider about this. But let's start diving into the financials. So the first thing you can see, long-term revenue trend has been up overall, but you can see there during the recessions, like basically a little bit longer time frame here, so I can show this just a little bit more accurately. 20 years, and you can basically see that the revenue, was good, and then basically slowly declined into the recession, and of 2009, this is reaching a low of $3 billion, and then it started increasing afterwards, and recently we basically had hit a high of in 2022 of about $5.1 billion. And now there's been another decline tracking to about 4.7 billion. And this is largely because of the industries they're in. One of their big components in industries is bed products, bedding. I think that accounts for approximately 40% of their sales or so. And mattresses just are economically sensitive. And you can see up here, I actually have two other mattress companies up here. You can see Sleep Number. You go there and, you can kind of see the, same trends here. Basically in 2008, 2009 contraction, they start booming again. And there was a big boom basically in 2022. And a lot of that's kind of contracted back down again. And, Tempur-Pedic here, or Tempur Sealy International Inc., same basically trend we see here. We go down to the revenue, and you can see there was a decline into 2009 during the recession. And then when the economy started to recover, sales started booming again. And what happens? Well, there's a little bit of a peak. For them, the sales haven't contracted too much, but it has been a little bit more flat. But because basically Leggett Platt does like OEM production for like other companies like that, other brands, like when there is overall contraction in the industry, it is going to hit them hard. And, we don't really know if we've seen the worst of it. There could be a little bit more, but we have to all keep that in mind as we do our analysis and go forward. But just is important to understand for companies like this, there is some cyclicality around the products they sell. So that is to keep in mind. So we basically can see here, gross margins, again, during the 2008, 2009, a little bit lower in 2008 of almost 17% gross margin. So it looks like they were trying to keep their sales up at the cost of their gross margins. And right now they're having a little contraction in gross margins as well, although typically they've been around 20%. So I wouldn't say this is too big of a deal. That we know there's a decline in that one part of the industry. So seeing the gross margins dip down is not really too big of a deal because of the industry they're in. Otherwise, this could mean they're losing a competitive moat, but they are one of the kind of few major manufacturers for private label mattresses out there. Go down next, see the operating expense. Exact same trend on the operating expense here. We're not seeing really a big discrepancy between their operating margins from the past and and in the present currently right now, which kind of means that their selling and general admin and other expenses are relatively keeping in line with their increasing revenue. So this is an overall good sign, I would say. The company is relatively stable from these metrics at least. minus that little bit of cyclicality that they can experience, and we really don't know if there's going to be more of a downturn or not. You can see interest expense relatively low, although it is kind of creeping up there. I'll say it's a little bit higher than I would like to see it, because you can see they had $91 million in interest expense, and they've got it a little bit under control down to $88 million, but their operating income has contracted, and it is taking up significantly more of their operating income. This is not a good ratio you'd want to see. $319 million in operating income with $88 million of interest expense. So, that's not the greatest. They're going to be wanting to basically work on paying down some debt if their sales aren't going to be rebounding right away. But it is good still seeing positive operating margins, even when they were in the past year and they're having $491 million of operating income and $91 million of net interest expense. It's a little high in my opinion. I prefer back here about this like 10-to-1 ratio, where you can cover your operating income, can cover your basically interest expense by about 10 times. So they have weakened a little bit on that perspective. So that is something we're going to have to keep on mind. It's not too terrible, because right now interest rates are high and sales are down. So right now they're at a bad ratio, but it's still overall profitable. Although it does show their income is negative, since they did have a big write-off. This is a non-cash expense. So sometimes when you're seeing, oh, they're losing money and this and that, it's not really on a cash perspective. They've written some bad assets basically off, and they wrote off $410 million here, but this was not real cash going out the door. So even though basically have negative net income, I wouldn't consider this actually a big deal, because the operating income is positive, and you also see that the cash flow is positive once down that a little bit later. And you can see net income here basically, again, fluctuates. We had, bad during the recession, basically ramped up over time, and now we're having some contraction, even into like a little bit of a loss because of these, one-time basically write-off expense, which is non-cash expense. And, that's leaving their EPS to fluctuate as well. Just to get into a little bit of the future forecast, because normally the charts on Guru Focus will show it, but it's not that. But we can go basically into the investor relations in here and kind of see their 2024 sales guidance, which is this current year right now. This also explains why the stock is down. So their adjusted EPS, $1.05 to $1.35. So now we compare that against their current APSs, and you can see compared to this last 1, 2, 3, 4, 5, 6, 7, 8, almost 8, years, it is significantly lowered. It's back kind of at these levels here. So the reason why the stock's down is they're currently are saying that in 2024, this year, they're going to be making a lot less money. And that's because, right now, maybe it's similar recessionary times of, economically bad times, at least, of a contraction of the market, because we know of the mattress and even the automobile industry, there's a little bit of the headwinds there. But you have to remember, markets are forward looking. So, maybe the markets right now looking at 2024 and a little bit into 2025. And, right now, maybe if we start buying now and then we start seeing better horizons in the future, maybe 2025 going to 2026, this could be a very good deal. But we're going to go over the financials, and this will all get into a little bit of how, I look at stocks, how I buy into them, my methodology overall. So you can see overall shares outstanding have been going down pretty much in the long term. They do a little bit of share buybacks, but they are mostly a little bit heavier in the payment of dividends. This is something I like to see. They could probably do a few more share buybacks, but again, the problem is, which I've gone over in a lot of videos, is companies tend to buy back shares when they have a lot of extra money, so they end up buying high, and then they don't have any money to buy low. So actually, in their case here, I'm happier they're doing basically dividends, because they are a little bit of an economically sensitive. Let's take a look at their balance sheet here. Basically, total current assets just under $1.9 billion. They got some reasonable cash on hands, accounts receivable, inventories. Inventories, you can see, compared to, for example, 2019, which now their sales are fairly comparable to, their inventories are higher. So they kind of got, again, like other people, trapped a little bit in this inventory trap with 2021, 2022, having the big, basically, boom happen. You get a lot of inventories made, and then, later in 2022 and then 2023, they're not selling, and now you're trying to sell off your inventories at a lower price, which is also probably why we're seeing that basically contraction in the well. So you can see all the financial statements all kind of connect together, and everything kind of makes sense. So inventories are a little bit high, relatively speaking, but it's not too bad. They have been lowering it. They're getting under control, and we can see and compare that to their current liabilities. Current liabilities basically are lower, which is good, meaning there's basically a positive current ratios. That's a nice thing to see for mid-cap stocks that typically don't have as good access to capital. it is more important to see these positive current ratios for them. So there's only 1.2 billion in current liabilities, and there's a nice surplus in current assets. So that's a good thing. And it looks like a little bit of this is short-term debt here. So this could potentially be interest-bearing short-term debt, which maybe is upping up their interest rate a little bit. I haven't really looked at it that too specifically, though, I look more at the overall basically picture of where things are going. I don't think this is too important at the end of the day. We can see that in the total liabilities, we got 3.3 billion, and you can see here the long-term debt. They've increased in 2022, and they have been decreasing it, and maybe that's kind of that why the interest expense hasn't gone down, because they have a little bit of more short-term debt and a little bit of more less longer-term debt as well. So this is something it looks like they're paying down, and maybe they're going to tighten their belt a little bit more going forward in the future and get that interest expense under control, which would be good, a good prospect for the future. And as we go further down, you can see basically total equity is sitting at $1.33 billion, although we do need to take a peek at the current basically assets here, which is $4.6 billion, but you can see there's goodwill. Goodwill is not real. It's just acquisition. You have to add it on for any additional you pay, which is just under 1.5 billion. So in reality, this total like equity we're seeing, stockholder equity, is really zero or even slightly negative. So overall, it's fair enough balance sheet. Not impressive. I'm not going to give them any extra points for valuation because they really have no surplus of value, but they don't really have any deep negative value either. And they do have the debt, as we already know from the interest expense. It looks like they're relatively trying to pay it down, and hopefully will a little bit more in the future. But let's basically pop into the cash flow statement. So what do you see? You can see cash flow from operations, pretty solid all the years here. Let's see, stock-based compensation. They're not a tech company, so it's very, very minimal, probably mainly to management. So at the end of the day, they really aren't, diluting and giving a lot of stock-based compensation out. So let's now check another a metric I like to take a look at is basically your cash flow from depreciation and your purchase of plant, property, and equipment. So as we can see, let's just kind of get an idea for the trend here. Gone up a little bit in the most recent years of basically how much they're appreciating, and the replacement overall tends to be a little bit on the lower side. So that is something to basically factor in, since that basically from an EPS front, it's going to make their EPS look a little bit lower. But we kind of do have to counterbalance that a little bit itself, because they do purchases of businesses along the way, and that kind of makes up, I guess, for reinvesting in their own business, the full and not giving the full replacement value of the depreciation. Well, they're doing acquisitions instead, and probably if I average this all out, it would probably reasonably average out to what it looks like the cash flow from depreciation is. There was this one big purchase here, but you look at all these others here where it's like $180 million of cash flow from depreciation per year, and only $180 million a year adds up quite a bit when we start adding up all of these. So overall, they're probably just replacement value overall. Long term, a little bit of growth, but it is fairly cyclical. Overall, fairly stable business, but economically sensitive, as basically we've seen from the sales here. And what do we see? Issuance of stock, very minimal. Haven't done any recently. Repurchase of stock, relatively minimal for them. They did a little bit more back here, and again, this is why I actually prefer companies actually issue dividends than repurchase stock, because you can see now that times are a little bit tough. They're basically repurchases have dramatically slowed down, but at least they're still basically paying out that dividend. So are they going to be able to continue this dividend in the future? Well, I think basically from the report here, they were saying they were planning to, on the assumption, but you never know what's going to happen. If there's going to be more of a deep recession potentially happening in the future, and they aren't making the money, well, they would probably cut the dividend. Otherwise, if this is kind of the worst, they may not. But you can never be sure with the dividend. But at least compared to stock buybacks, I kind of do prefer the dividend a little bit more, because it's kind of more of a guaranteed that the companies are going to give that cash back to the shareholders even during the bad times, unlike the repurchase of stock, because otherwise then you're just buying stock high and then selling it low, relatively speaking, which isn't so good. And remember, I was saying it with the free cash flow. You can see free cash flow is still positive. This whole worry is about seeing negative PE and them losing money. It was just a one-time basically write-off expense, and was not really money going out of the company. So Okay, now let's look at the interactive chart. Let's pop up basically the revenue with estimate, and also let's pop up the EPS with estimate here. And you can see the revenue after the decline in basically 2005 into 2009, it's only been recovering since then and gotten a little bit higher. Now we're having a little bit pullback now. And the question is, well, are things going to contract more or aren't they? But you can see the EPS, despite that, while choppy, has been actually relatively trending up. Let's get rid of the revenue with estimate there. And you can see overall, it actually kind of fairly well kind of correlates with the stock price, has been running up overall, probably because they have been doing some share buybacks. So even though a stock like this, if it does kind of have more flatter revenue in the future or is just going up with inflation, they still can put on gains by doing some share buybacks, or you're going to be getting those returns in the form of dividends. Let's look at a few more metrics here. Look at the price to sales ratio. And you can see, let's go to actually to 25 years, since that's all we can really look at. It is at one of the more historic lowest levels. There's actually a little bit more if we go 30 years back here, and we can kind of see some of these other dips. So right now, from a price to sales ratio perspective, the stock is being priced for a lot of doom and gloom, as it is actually at a very similar level as it was in 2009. Could things get worse? Yes. Is that likely? I don't really know, but I think it is kind of relatively worth the risk to buy in the stock, assuming there is going to be some, better times going forward. The mattress industry, the car industry, these things that they have exposure to will recover in the future. They are a little bit cyclical, and this is relatively saying could be a good valuation. We can also kind of do this trick with the dividend too, get an idea of that, and you can see right now the dividend yield is extremely, extremely high. But is this dividend yield actually sustainable? Well, let's pop into the financials here. And remember, they're projecting maybe EPS of $1.35 next year, though they are still planning on paying the dividend. I just want to give you an idea of basically how much that would actually be at the end of the day. So if they were making, $310 million here, they're paying a $2.28 dividend. Well, going forward in the future, they may only make half of this, which would be $150 million net income. So then we kind of come back down to the cash flow statement. And again, one of the things is you have to remember that EPS is because cash flow from depreciation is a little bit higher than basically what they're doing of purchase of plant, property, and equipment. So, we can factor in kind of a little bit more of some millions, some tens of millions there. And well, they do have a $239 million dividend. And well, there's the cash flow this year was $383 million. It could potentially be a little bit lower next year. So it kind of looks like they're on the verge of being able to cover the dividend next year, which is why on their base reports they're saying they're kind of expecting on paying it. But if there would be a worse economic downturn, you could probably most likely expect they're going to cut that dividend, since right now where their business is, they're maybe just going to be able to fulfill it. They are planning on doing some restructurings. So hopefully all this kind of goes through and gets their cash flows a little bit more efficient. Let's look at stock chart. I find it's always good to look at stock charts and kind of gives you an idea. And again, this is this whole kind of similar thing of the economic cycle. They peaked in their sales in 2005 and then they declined in 2009. And, we kind of had a similar thing, peaked in 2021. We've declined in here. So this by all means could be a very good time to buy the stock. I've had these levels looking at for a while. And this also gets a little bit into my methodology for buying it. I never really know how bad things are going to get into a stock. You really can't predict any of this stuff on what the levels. So, when things are up here, it was like, you started looking at it. This could be interesting back here. You had the support level there. It was a relatively good valuation, but then things contracted more. And then I already have these levels at about $23. $17. So I started buying a little bit more position basically at $23, $22 here. That was short-lived. And now basically I'm looking at buying more. But I kind of, when I even start buying at these higher levels, I am planning that if things take off, well, I have a nice little position. I would make some money at it. But if things do get lower, that's when I am really looking at actually kind of making it a little bit more substantial position. So I recently have started picking away a little bit, although this probably isn't going to bottom overnight. And you can see I am looking at potentially lower prices. So when things start pushing below a little bit, 18, a little bit more, I'm going to be buying a little bit more Leggett and Platt. Another nice little thing you can look at in Groove Focus is, especially for these dividend stocks, is adjust for the dividends they've paid out. So it actually gives, other than misaligning my channel here, it does give quite a bit different view. As you can see, once we factor in the dividends they've been paying, basically they're still above the COVID lows. So this is kind of other, potential support it's at. And, maybe things actually aren't as bad as they are. And that's one of these stocks that do pay a lot, all their cash flow out, rather than basically buying back shares. Is the stock charts will look a lot weaker because they have paid out all those dividends. Either way, I'm being interested in Leggett and Platt. I've been finding a lot of these different kind of more mid-cap companies that I feel are going through just kind of economical, cyclical trends with everything that's happening with inflation, the stagflation, recession or not recession. You know, some industries were experiencing recession. So, I've been finding a lot of value in these. Not all of them are going to basically work out, but I think over the long term, enough will that it can provide some substantial gains. As you can see back here, basically, well, Leggett and Platt, was at a low of like, $10 to $12. It did quickly recover to 26, just in a couple of years, which was very good gains, and continued 54 in the longer terms. 5-6 years later, if you were buying around the low here, that was potentially a 4 or 5 bagger you were making on your stock there. So, potentially from a longer term perspective, this is what we could be getting. Although, again, this is assuming that we're not going to fall into a further economic, basically, recession anytime soon, meaning mattress sales and car sales for the seats which they sell are going to go down further, and we're going to see some stabilization in their business, their inventory, and that going forward. Although this could take a little bit of a bottoming process, you never know how long it's going to take. So the one thing is, when buying stocks like this, don't shoot your load all at once. Basically, leave dry cash. Say, hey, I want to build up this position to whatever size, and I'm prepared to do that basically over a year time frame. At least that's how I like to look at stocks, and how that seems to work a little bit better for me, being able to kind of like average down when you do potentially get these really good deals. So anyways, I hope you like my stock analysis. I hope you like my also approach into how I, am personally basically investing in Leggett and Platt myself. And make sure to subscribe to the channel, like the video, and if you do want me to cover something, leave it in the comments below, and I will see you in the next stock analysis.